Losing a spouse is absolutely heartbreaking. It can feel like your entire world has frozen in place, but then something else begins. A clock. A 9-month clock with the IRS. And what most people do not realize about this critical window can literally cost them everything they have worked to build. So let's talk about what you need to know. This is information that honestly every single person should have, yet almost nobody discusses it. And look, this is not just some made-up scenario. Let me tell you about a real-life story involving a 71-year-old widow from Pennsylvania. Her husband passed away. They had lived in their home since 1990. It was fully paid off. Everything seemed fine. She assumed, I'm okay. She did not sell the house. She did not touch a single account. But then 9 months later, out of nowhere, a notice from the IRS arrived. She owed more than $6,000 in fees. And the worst part? She lost access to a tax exemption that could have protected over $13 million. All because she missed a deadline she never even knew existed. That is what we are here to help prevent. We are going to make sure that does not happen to you. This is the number you need to lock into your memory. 9 months. The clock starts the day your spouse passes away. And the IRS, well, they do not stop for grief. What you do, or more importantly, what you do not do during this short window, makes all the difference. It is the difference between protecting everything you built together and watching a huge portion of it disappear into taxes and penalties you never even knew existed. Okay, so here is how we are going to handle this. First, we will go over the 3 major financial traps to watch for. Then we will get into the important stuff: protecting your home, preserving your estate, and safeguarding all your other assets. And we will finish with a final, very clear action plan. All right, Section 1. Let's really break down why this is such a big deal. It is not just one small issue. It is actually a perfect storm of several risks that most people do not realize are coming until it is too late. So what are these traps? There are basically 3 major ones. First, there is the IRS. They want a federal estate tax return filed, or at least a deliberate choice not to file, within those 9 months. Second, there is your state. Many states have their own estate or inheritance tax. And guess what? Their exemption amounts are much, much lower. And third, and this is a big one, are your own mistakes. Small errors, simple oversights can trigger massive, completely unnecessary capital gains taxes later on. We are going to walk through how to avoid all 3. Okay, let's start building your defense. And we are going to begin with the biggest asset for most families: the home. This is ground zero for the most common and most expensive mistake. But it is also where you will find one of the strongest tax breaks in the entire system. So there is a term you need to know. It is called stepped-up basis. It sounds technical, but it is actually your best friend. This is probably one of the most valuable and most overlooked parts of the tax code. Here is what it means in plain English. The IRS basically presses a reset button on your home's value. They act as if you bought the house for whatever it was worth on the day your spouse passed away. All those years, maybe decades, of the house increasing in value, gone. For tax purposes, that gain simply disappears. Let me show you how huge this can be. For example, say you bought your home years ago for $120,000. Now, on the day your spouse passes, it is worth $450,000. Okay? If you did not have this step-up rule and you sold the house, your taxable gain would be an enormous $330,000. But with the step-up, your new cost basis resets to that $450,000. So if you sell it later for, say, $460,000, your taxable gain is only $10,000. I mean, the difference is astonishing. So what does that actually mean for your pocket? In that exact example, that one rule could save you around $50,000 in taxes simply by having the right paperwork. One simple action can literally protect a lifetime of hard-earned equity. It is enormous. Okay, so how do you prove this to the IRS? You cannot just assume, right? That brings us to action step number 1. You need to get a formal date of death property appraisal. Hire a licensed appraiser, ideally within 60 days. It may cost a few $100s, but that report is your golden ticket. It is solid proof for the IRS. This is something wealthy families do automatically. Their attorney simply orders it. It is time the rest of us knew this strategy. All right, so we have secured the house. Now let's zoom out and look at the whole estate. This is where that 9-month clock really comes into play, and it all centers on one specific IRS form. So that 9-month deadline we keep mentioning is the filing window for IRS Form 706. That is the federal estate tax return. And right now, you are probably thinking, wait, the estate tax exemption is around $14 million. I am nowhere near that. I do not need to file. And that assumption, that one thought, is a multi-billion-dollar mistake waiting to happen. Here is the trap. You are thinking, my estate is under the limit, so I do not need to file. But here is the reality. Filing that form is not about paying tax today. It is the only way to capture your deceased spouse's unused exemption and add it to your own. That is called portability. Think of it like this. Your spouse has a $14 million coupon, and if you do not file this form, you just throw that coupon away. It disappears forever, and you lose access to millions in future tax protection, which brings us directly to step 2. And you need to do this quickly, like within the first 30 days. You need to speak with a professional, a CPA, and an estate attorney, and ask one question. Should I file Form 706 for portability? They will help you determine that. And if the answer is yes, you must get it done before that 9-month clock runs out. Do not let this slip. All right, step 3. This one is simple, but so important. You need to update the title and deed to your house. You just need to remove your spouse's name officially. Go to your county recorder's office with the death certificate. It is a straightforward filing, probably costs less than a nice dinner out, but it can save you thousands, and I mean thousands, in legal headaches later if you want to sell the home or refinance. So let's say you have all your federal matters in order. You feel good. You might be safe from the IRS, but are you safe from your state? That is the question almost everyone forgets to ask. Just because you are clear with the federal government does not mean your state will not come looking for its share. And this is a huge trap. The federal exemption is nearly $14 million, but states follow completely different rules. Look at Oregon and Massachusetts. They begin taxing estates over just $1 million. And remember that widow in Pennsylvania? Their state has an inheritance tax that applies from $1. There is no exemption. This is how ordinary middle-class families get blindsided. And here is the kicker. Many state deadlines are even shorter than that 9-month federal deadline. You have to stay on top of this. Okay, so we have covered the house. We have covered the estate. But there are a few more really important details we need to discuss. Let's make sure we protect all the other assets you have worked so hard for. This brings us to step 4, and please do not skip this one. You need to review every beneficiary you have listed. I am talking life insurance, IRAs, 401ks, everything. And here is why this matters so much. A beneficiary form overrides your will. Let me say that again. It overrides your will. It does not matter what your will says. If you have an old 401k from a job 20 years ago that still names your ex-spouse, they get the money. Not your kids, not your estate, they do. Spending an hour to fix this can prevent an absolute disaster for your family. And last but not least, step 5. This is one that can put money back in your pocket every year. You need to call your county assessor's office. Ask them specifically about property tax exemptions for a surviving spouse or widow. Almost every state has some kind of program. It could be a reduction, it could be a tax freeze. But here is the thing. They are not automatic. You have to apply for them. And if you do not, you could be overpaying your property taxes by thousands of dollars every single year. Okay, I know that was a lot of information, so let's bring it all together. Let's turn it into one simple final action plan. This is your 9-month checklist, your guide for getting through this. Here it is. Very simple. Step 1, get that property appraisal. Do it within 60 days. Step 2, speak with a CPA about Form 706 and do it within 30 days. Step 3, update the house deed. Give yourself 60 days for that. Step 4, review all your beneficiaries. Another 30-day task. And step 5, apply for those property tax exemptions before whatever deadline your state requires. That is it. This checklist right here is the whole game. The difference between someone who protects their family's finances and someone who does not. It is not about how much money they have. It is about knowing these 5 steps. So I will leave you with this thought. You have spent a lifetime building something together. Are you ready to protect it? The most important thing you can do now is make sure that legacy stays secure. And please, if you know anyone who needs to hear this, share it with them. Do not let that 9-month clock catch them off guard.